After last week's breakout above 6,000, the S&P 500 paused just below all-time highs, gaining a modest 0.1% as traders shifted into semiconductors today, as well as metals. That's been a common trade lately. Silver surged over 2%. Bitcoin had a pretty decent move as well. And falling bond yields lifted the rate-sensitive areas under the surface. It was all about the selective rotation. In today's market outlook, I'll break down what this quiet session is really telling us, show how today's intermarket moves hint at a bigger narrative shift, and walk you through a bullish trade setup in Freeport-McMoRan that's built to benefit from this commodity momentum. So let's go ahead and get started. Today is Monday, June 9th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, really quickly, if you're watching us here on our blog, I wanted to highlight some of the few changes that we made to our Market Outlook post. You can see it's pretty robust now. It's got a lot of information here. Quick summary of what happened in the day today. Quick summary image. If you scroll down, you can see all the main categories that we've been putting on there here lately, but we've added some images. I've added some images to it. And also you see this button. And this is a significant change. I've been doing market forecast videos on YouTube probably for about 15 years now. But this is the first time that we're going to make a change to it. As you know, it takes a lot of time to do these videos. And I believe that there's a lot of value in them. That's why a lot of you come to them day after day after day. So what we decided to do here was to add a subscription level to our pricing page. If you go to our pricing comparison, you can see all of our levels there. We've added a level here to start to make this a premium product, the Market Outlook video, the full version of the Market Outlook video, a premium product. Now, for the rest of this week, it will be free. But from then on, you can see we're going to start charging $29 a month for the Market Outlook videos. With that, you also get the Market Outlook live videos that I host on our website, a live stream at 3:30 Eastern Time, where I take a look at all the Market Outlook trades we've done in past videos. Just talk about whether to stay in them or get out of them. We also put on the trade idea before the market closes for the day. But for $29 a month, it's really not that much. It works out to being less than $1.40 per video. If you sign up for the yearly version of this, you get 2 months of that for free. So it's $290 per year. So 2 months are free. So it works out to being less than $1.20 a video. So I would hope that a lot of you will find that this video is valuable enough to be worth at least $1.20, or if you do it monthly, $1.40 per video. In addition to the trade management aspect, which I've never offered for free on the Market Outlook video, but would be part of this as well, the trade management of all the market outlooks. And if you listen, if you talk to all of our market scholars who have been listening to Market Outlook Live, these trades, we've done a pretty decent job on all the Market Outlook trades over time. Also, again, since this is live now, but again, for the rest of the week, it will be free. For anybody who signs up by June 15th, I'll be giving out a video on sector rotation, a technical analysis video on sector rotation here, again, for anybody who signs up by the end of the week, essentially by the end of the week through Sunday. So again, it will be free the rest of the week. After that, the version that you'll see on this page, on the Market Outlook page, will just be a 5-minute free version of the video. You'll see up here. And then again, you can sign up and get on our website to the full Market Outlook video that will also be hosted on YouTube, but will be unlisted on YouTube. So that would allow me a couple of things. It allowed me to be able to put the time into this that I would like to, that you would like me to be able to do this day in and day out. Number one, and number two, I don't have to do the ads on the video anymore. So I'm going to turn off the ads on the YouTube videos. So you don't have to watch those anymore. But again, so that's going to be the replacement is, and that kind of gives you an idea of how we get started here at Market Scholars. It's going to give you a foundation level. That's what we're calling it, our foundation level pricing tier. As you can see, we've updated our levels now to a core level where you get half of our trading rooms for the pricing you see here, and then our premium level where you can get all of everything we offer for these pricing levels, and then finally our elite level, which is what our premium level used to be, but essentially locks in the premium for 3 years with no price changes. These are all subject to change from year to year, but this will lock you in at no price changes for a significant savings to what you're getting here. And again, this is when we do the Black Friday sale, this is what will be offered for 80% off or 20% off, excuse me. And that's even more of a significant, I think with the 20% off on the Black Friday sale, it works out to like $77 a month that you lock in for 3 years before the price changes. So, but even with the full price, it's still much better than the 129, or even if you do the yearly where you get the 2 months for free. So this works out to $108 a month, and then this would work out to $97 a month over the 3 years. So much better than 129. And then, like I said, it drops down to like $77 a month when we do the 20% off. So that kind of gives you an idea of, and you can subscribe for the foundation to get the Market Outlook videos here. You can do it either, or you can go to our foundation landing page here. But you can subscribe for either one of these by clicking on our pricing page, either the monthly or the yearly, and it takes you to this page. And like I said, for those who sign up for the course of this week, our founding members of our foundation tier, you will be given that the technical analysis video on sector rotation. Of course, if you are already a premium subscriber, you'll get this. You'll continue to get the Market Outlook video just like you always have. But now it will be a part of your subscription rather than something that I've been doing for free for everybody else. So it's a little bit more of a value add for our current Market Scholars community. One more quick note too, as you're watching here on our blog, you do have to subscribe to be able to see the Market Outlook blog post. You do have to subscribe, but the nice thing is you only need a free account to do that. So to see the blog post itself, again, after this week, it will contain the preview version of the video, but it will still be the blog post, and you have to subscribe here. If you go to our pricing page, it's actually our basic subscription, our free subscription, that gets you access to all of our blog that we have, as well as special webinars that we'll have for people that are subscribed to our site for free, as well as our community forums for just our free subscribers as well. So that's all. That will be parts. When you go to the Market Outlook and you see this, you can create your free account by just clicking on that button right there. Or and you can see it's a really easy subscription process to do that. Just sign in with your name, username, email, and password, and that gets you on our site. And then that gets you access to this. And then if you're not logged in, you can log in at the top over here on the right, or underneath here. Just click on login here. Let's go ahead and get started and take a look at the S&P 500 with the market forecast indicator. As you can see, we continued higher today, but not by very much. It's been a very, very small ranges over the past few days. I mean, today's range was 27 points out of 80. So it continues to this grind higher, and that's kind of what we expected, right? We've been talking about this grind to the upside. But as long as, again, the intermediate line is still strongly bullish, market sentiment still rising, now in bullish territory, the near-term line still hasn't dropped into bearish territory. So we've been on, I mean, there's been some ups and downs, but we've been on one big long near-term rally so far. Hasn't been as big as the last near-term rally, right? That near-term rally there was pretty, was a bigger move. You can see on a coming off of the low point, well, even if we just went to the lowest low up to the highest high point, that near-term rally was what, a 7% move in 9 bars, whereas this current near-term rally from low to high is a 4% move in 11 bars. So you can see a much smaller move, but we're still more than 3.25% above the 30-day moving average. Near-term line still in the reversal zone. I mean, we're not getting a cluster because we're getting small ranges, but it's still doing okay. If you look at the NASDAQ 100, again, very similar. Intermediate lines up, still on the same near-term rally. It actually did have a little bit more of a near-term pullback than the S&P did. We're grinding up towards 52-week highs, but not really like blowing up towards them. If you look at the Dow Jones Industrial Average, this one's not even close to the 52-week highs, so it's a lot further back. But other than that, it still looks very similar. We're close to the old highs that we had from May. So we're still on the same intermediate rally. Its market sentiment, its intermediate line's above the 90th percentile as well. Its market sentiment line is rising. At least it's above the 50th percentile. It's not quite in bullish territory yet. The one that's really been lagging is the Russell 2000. The small cap index, as you can see, is way below its all-time 52-week highs. Excuse me. The intermediate line strongly in the upper reversal zone. The near-term line strongly in the upper reversal zone. So a good day from that perspective, but half the range of the average range. That average has come way down. We're still more than 4.25% above the moving average. So there's still we're still pretty strongly bullish here, but not, again, coming up into these old highs, coming up into these 52-week highs. We expected that we'd start to see some resistance. If you see on a zigzag basis here, on a zigzag chart basis here, you can see we're up 16% off of this last red tag that we got. Remember, when you get 5% pullbacks, you're going to get green tags with double-digit numbers in them typically afterwards, and that's what we got. But we're coming up into old resistance without a 5% tag. So we almost got a 5% pullback here, and that would have been great because then we could just blown through the old highs with a double-digit new green tag. But we didn't get that, so we're still on the same ones. We're approaching this high. It's not going to be quite 20%. It's going to be around the 18-19% range as we approach it. And that's kind of why, we're losing buy-in interest, right? Not that we're not going up. We're just not going up to the same degree. We're really starting to slow down, as you'll see in some of these other oscillators. We're really starting to slow down here, and that's what you're seeing in the market forecast as well. Strong bullish posture, so nothing to worry about. Strong, the near-term line's been up and down, but still hasn't been bearish, so nothing to worry about there either. And then you can see, like I said, still strongly above the 30-day moving average, that's the important thing too, is that we stay, even though we're not surging with momentum anymore, we're still strongly bullish when you look at the different indicators, even if we are slowing down. If you look at the weekly chart, you'll notice the size of the candle is still pretty strong. It's above its 3-week average. It's a higher close. It's a higher high, slightly higher high. It's a higher Hakunashi close. I mean, those are all really, really good signs for the market. We're in a golden cross environment, sitting at that 6,000 level. If I look at the 3 green arrow chart, obviously we have not had 3 green arrows, but we do now on the Russell and the Dow Jones. We do not quite have it yet on the S&P, but we're so close to getting that 3rd arrow on the MACD, and that's really when I say that we've been slowing down, that's what you've seen. The MACD has been below its own average, which is why the histogram hasn't turned positive this whole entire time. So we've been above the 17-day average, which is the second number here, but we've been below its own moving average. So that is a bearish sign, not a bearish sign. It's it's not as bullish as what we've seen. As you saw, this near-term rally has been a lot slower and smaller, and because most of it, pretty much all of it, has been in convergence mode, where you are above the second number, which is the 17-day exponential, second number in the MACD. You're above the 17-day exponential moving average, but we're grinding below this average here, right? So that's kind of a divergence there. We call that a convergence period, where you don't really have a lot of momentum. It's not really an impulse move. You're still pointed higher because you're above the moving averages are still going up, but you're just losing momentum pretty rapidly there. That's not bad, right? It's bad when you get below the average, right? Get below the 17-day average along with the MACD below its average. So that's bearish, and we don't have that. It's an in-between stage between being strongly bullish like we were here and then being bearish like you are, for example, over here. So it's like an in-between that you happen to still be bullish. If you look at the DMI, you'll notice here that the positive indicator is still above 25. It's not above 30. The negative indicator is still below 20, and see, we still can't. I mean, look how strong this trend has been, and we still can't get that ADX above 20, right? Which is what gets the, you can see what gets the shading being green here, and we haven't been green. So it's very, very strongly bullish. But remember, a lot of this rally has just basically been a rebound of the decline. So again, when you go back to you go all the way back to November the 8th, and that's 7 months ago, we haven't moved. The market hasn't changed in 7 months. So it puts into context, the decline, the correction, and the rebound, and how bullish this is. But the reality is, in 7 months, we're flat as a pancake. Flat as a pancake. From one day to the next, right? With a lot of volatility in between, but still no return at all over a pretty extended period of time to have no return. When you look at some let's see here, let's look at the RSI and the CCI. We're still bullish here. You're still above green. We have turned bullish. Last week, the weekly CCI crossed above 100, so it started to turn green here. We're still above 100 on the daily CCI. We're still above 60, so we're still showing positive patterns on that indicator, even if we're not necessarily surging with momentum. When you look at the Ichimoku cloud, we still have a mature bullish trend, a very strong, mature bullish trend. When I say mature here, that doesn't mean that we are like overextended. That means we have a very strong trend. It's hard to break very strong trends. As you can see, if I zoom out here, it's very hard to break very strong trends. When you do, then they typically lead into intermediate declines. But as of right now, but they're hard to break, and you can see, the 26-day range is starting to move up. We have a very positive rate of change here, and we are about to approach the green line, and we're not even close to dropping below the green cloud. Excuse me, the cloud is huge. This is one of the bigger Ichimoku clouds I've seen. So very, very big cloud there. When you look at the Bollinger Bands, the bandwidth, look at that bandwidth. It's just plummeted over the past week. We are above the upper band, right? So we closed above the upper band because that bandwidth has just plummeted, absolutely plummeted. The bands themselves have actually moved inside the Keltner channel. We moved above the band, but we're not above the upper Keltner channel. So we've been sitting this whole convergence period. We've traded below the Keltner channel. When you want some momentum, you got to be above the Keltner channel there. So we've been losing momentum, losing this bandwidth, and pushing down. You can see that as well on the the trading range. Well, let's look at the intraday move here first. We did get a new high, and you can see that the low point moved up to right there. That's where the new low is on the Arun indicator. So that's why the red line moved up to almost the chart's midpoint. But look at the channel width is really because it's moved up so much, the width of the channel has really dropped. You'll see that tomorrow. It'll still look like this, but we just lost, from 562 up to about 575, about 13 points of range in the 4-week range, and that's why it's dropped down like it has, which is now going to make it a lot easier to drop in this. We're still very strongly bullish over the 90th percentile, but when the range is so truncated, it makes it move out of bullish territory or even into bearish territory a lot easier. And so that's a grind. I mean, we still have a pretty, last week's range. Now remember, this midpoint is going to move up quite a bit, actually. So last week's range is pretty much going to be most of the 4-week range here. So we're really, really tightening up here. And you can see that as well in the ATR, right? Today's move, remember, was very small, but the ATR is well below 1.5% now. Remember, getting below 1% is the ideal because we can just really grind up for a long time with very little volatility. In fact, if you look at the volatility index today, the VIX actually went up, but it's still well below 20. It's well below 90%. So it's right in the sweet spot of bullish territory for risk appetite. It's the VVIX has dropped and crossed below 90. Perfect levels for the VVIX. You can see the correlation strongly positive. We got a little bit of a bounce in volatility after this drop in the correlation, but that was it, and that's great, right? If that's all we get, that's really all we want. And as we've talked about before, the VIX is below its own 200-day moving average, and not very far below it. So while the volatility is low, we're not extremely complacent. So we're kind of right in the sweet spot where there's not a whole lot of concern right now in the markets, and it's not extreme. So that means it can maintain itself, even though yes, the ATR has fallen off the cliff, right? And yes, the Bollinger Band width has fallen off a cliff. And yes, the momentum here has fallen off a cliff from extremely high levels. But these have, yes, they've all fallen, and the bands themselves have moved inside the Keltner channels. So we're not as strongly bullish as we were. And we're back into a range that we were in before the correction started. But, I would rather be closer to the top of that range with the potential of breaking out than, still down here working out through this correction with any potential new legs. So that's the positive that you can get in the markets. It's a grind, but we love the grind, right? In the case of the stock market, I mean, yes, it's kind of hard to, like, if you really want to make a lot of money, then you can trade Bitcoin, right? And Bitcoin's very volatile. You can use its leverage products. It was up 4% today. It's already up 1% tonight. Like, there's, if you really want to make a lot of money in a short amount of time, but if you want your retirement accounts to continue to move up, then this is the perfect market environment for that right now. And now let's talk about what's driving a lot of this price action. So let's pull up the asset class comparison chart, and you can see again, there's been a common theme, but gold continues to dominate 3-month returns, but equities are starting to show much better 3-month returns all across the board too. Qs, IWM, international stocks, U.S. stocks, bonds are down, the dollar's down. But that means bond yields have been up, but hasn't been up today. Like today, if you notice here, bond yields, bonds were up, so bond yields were actually down. We actually dropped back below the 4.5% mark. Emerging markets were up, small caps were up the most today. The Qs were up pretty good. A little bit of a pullback into the late. I mean, everything else pretty. I mean, the scale here is really small. Like a lot of these moves are very, very small. And these were the outliers, especially on an international basis. If you take a look at the international charts here, I'll take a look at the 12 grid. You can see China up 1.25%. They're the biggest emerging markets. India is doing pretty well. Korea has gone parabolic. So a lot of the bigger emerging market names are doing pretty well. Brazil's really the only one that hasn't. A little bit of weakness there. Developed markets are doing pretty well, but they're in a grind too. All these European markets are all in a grind. Even Japan, very similar to the U.S., whereas emerging markets are kind of going a little parabolic. So we see that. And if you take a look, and part of that's that you can see Bitcoin had a big run today. But part of that continues to be the dollar. The dollar continues to trade. Here, let's look at the dollar index. Trade in this bearish trend. It's hovering around 100, so it's not dropping sharply, but it's still staying down enough to help the market stay in this kind of bullish scenario. Again, kind of this, I don't want to say the word complacency because that implies an overextended move in the markets, but it's a good complacency where again, there's just not a whole lot of volatility. There's not a concern. There's not a move in the safety trades anymore. We've been starting to rotate out. We had that kind of move in the safety trades a couple of weeks ago. We've been starting to move back out of safety, and so I mean you can see that metals are still pretty strong because of the weakness in the dollar, but it's not necessarily like. I think it's more of a is there a need for an inflation type hedge? We're going to have a basket of inflation data due out this week, and then obviously at the end of the month with the PCE. But I think that's kind of the concern. I think we might start to see inflation levels start to become a hotter topic, whereas the employment picture had taken the reins, so to speak, in terms of dominating market headlines. Now I think it's more of the inflation picture that is dominating the market headlines, and you see that with gold doing as well as it has been, Bitcoin doing as well as it has been, even silver, which is not necessarily an inflation hedge, but it's a metal. It's like really, kind of going parabolic here, with a breakout over the past week. up to new 52-week highs. So strong move in the metals, strong move in Bitcoin, with not necessarily, as I mentioned, a strong move in yields, as yields ended up down just below the 4.5% mark. So we're still up. We got dark green shading the green line. The intermediate line still above market sentiment. Everything's rising. Strong near-term posture. We had a strong finish with yields last week, but we're not breaking out of the ceiling, right? Remember, the ceiling is 4.5% because that's where the Fed funds range is, and that's what we're going to need to keep our eyes on. As I mentioned to you quite a bit here, it's the Fed, the idea that the Fed, the market prefers the Fed not to raise rates, or cut rates, excuse me. They want the Fed to have the cuts on the table, but they don't want to cut rates. And we have taken the rates completely off the table in June. So that's coming up next week. Here on April the 8th, we were at 100% odds of a rate cut at this next week's meeting. 100%. That's just 2 months ago. We had 100% odds that we'd have a rate cut next week. Those are gone. And you've seen how the markets rallied as a result of that. Those are gone. We actually had a 50% chance of a second cut there. So you look at September now and you say, okay, well, September we had, the odds of a cut back on April the 8th, were, again, almost about 98% chance of 2 cuts, right? The 100% chance of the one, a 98% chance of 2, and about a 78% chance of a third one, right? I mean, the market was pricing in a rate cut cycle starting there in June. But if you look at now, the meeting for September, there's only a 60% chance of a cut. A 60% chance. So you can see just a month ago, it was an 89% chance of a cut. Just a month ago, right? That's not April the 8th. That's just a month ago. And the odds have really changed. And again, December, where at one point in time, there's a high probability, like a 60% some odd probability, that we'd have 5 cuts starting in June, going all the way through the end of the year. Now you can see there's about a 90% chance of 1, and that's, remember, it was 99 a month ago. But you can see there's only a 60% chance of a second one, right? So 40% chance of 2 cuts, and a 60% chance of 2 cuts, 40% chance that we don't get the 2 cuts, 8% chance that we only get the 1, or that we don't get any, 31% chance that we get the second, just the 1 cut. Or 92% chance, excuse me, we get the 1 cut, and then a 60% chance that we get the 2, and then after that it really drops off. So the market's not worried about cuts anymore, and that's great. That's what fuels the market run up to the upside. So as long as we stay at the upper end of this 4.5, 4.25 range without pushing through it materially, because if we are pushing through it materially, then that means inflation is becoming a hotter topic. As I mentioned here, it is due, right? Inflation wasn't very strong at the last result, but when you look at, let's see if I can find it here, the nowcast for the next meeting, this is exactly what we want to see, right? This is the May result that's going to be released in June. The low inflation is expected to pick up in June. That will be released in July. But as of right now, that's exactly what we want to see. Now, you can see a jump up in what it does, but the headline's going to be at 2.4. The core is going to be under 3%. I think the market's really going to like those numbers. And again, taking those odds off the table is what we all want to see by the end of the year. That's what's going to fuel a run to where, again, we can run up to a year-to-date return. If I were to go year-to-date here, we all want to have a strong year-to-date return. Here, let's go to the beginning of the year. Oops, let's get off this 5-year month chart. A year-to-date return, and it's not, the goals had a year-to-date return of 26%, but if we can get the S&P up to double digits by the end of the year, then we're going to need to see inflation tame and rate hike odds come down. And as we saw today from a couple of sources, that earnings expectations and GDP expectations, in fact, when you look at the GDP now, let's see here, do I have it on this one? I believe I do. Here it is. If you look at the GDP now, look at that big jump back up to almost 4%. So we had a big drop last quarter. Well, it's expected to rebound pretty significantly in the next quarter. So there's a lot of positive expectations going into the end of the year when it comes to earnings expectations, economic growth expectations, tame inflation expectations, and employment. As long as employment can avoid a turn to the upside, then I think that's our sweet spot. It'll be a grind, right? We won't have the big, huge run up. When you have valuations as high as they already are, you're going to be limited in your returns. I mean, we're already at 37, approaching 40 on the CAPE ratio. So we're not going to go up a third year in a row of 20% or higher as much as, it would be nice if we did, but we're most likely not going to go up for another year. And we're going to have volatility now, and any gains to the upside will be limited by the fact that we're already so overvalued. But at least, again, we're avoiding as long as we have the mature trend here, the mature trend on, let's see, that would be the Ichimoku cloud, then we can really get going and stay there. And especially when you look at on the weekly, on the weekly chart, we're just getting started. We still have a weak trend. And you can see when that gets going, these are all weeks. So when this gets going and gets above these dotted lines and eventually gets above the mature levels, then again, yes, we're bullish for a very, very long time at that point. Back above the cloud turned pink during this correction, a very weak correction, but we're already back above the cloud there. So we have a good chance that we can start. It might not be as big as this one, might not be even as big or long as this one that we had here. Probably won't be. But any intermediate strength trend we can get on this weekly basis, then that avoids the kind of moves that we saw earlier in the year. We can avoid that, hopefully for another year or two. Let's take a look at the sector rotation and how it performs here. You can see technology has been rebounding in a big way. If you look at just today alone, technology actually did pretty good today. Right, actually held up pretty well. Initially energy was doing well, but it pulled back. Discretionary was doing weak, but it jumped up and finished the strongest. And materials actually were your best performers. Interesting to see two sides of a interest rate sensitivity coin, financials and utilities both performing in the same direction, with yields falling down, but did not necessarily, it hurt financials as you would expect, but it didn't necessarily hurt utilities. Also, and even if you say, okay, well, utilities aren't interest rate sensitive anymore because they're the AI play now, that wasn't necessarily coupled here. So kind of a soft move, but at least if you got technology and discretionary leading the way higher, then that's what you want to lead the way higher. When you look at the breadth is obviously soft. When you're in these convergence periods, you're going to have soft breadth, but at least it's positive. At least the summation index is above the 500, the positive 500 level. And then when you look at these breadth indicators that we like to look at, like the number of stocks above the 50-day moving average, so that'd be right here, I believe. That it's still strong, right? We're not breaking above 400, but we're still above the average. The average is high, but we're still above 300. We're still in bullish territory. We're still above the average. Number of stocks above the 200-day moving average is back above its moving average and back above 250 as well. So the ratio is still down, right? Remember, we don't really want it to cross above its average unless we're getting a nice, good breakout on the number of stocks that are breaking, that are above their 200-day, that breaking above 300 and staying up there for a while. That's the kind of breakout we want to see, as well as a breakout of new highs. The average now is broken above 100, so that's a very good sign. From a breadth perspective. So breadth is actually not looking too bad. The skew is above its average. It's not too extreme, but it's above its average, and we'll see if it starts to break out here and start to move again, because you can see it starts to break up when you are bouncing, but if we're really going to move up, the skew is going to move up too. And it has been, and it's above its average now. We kind of need to see it, break through this 140, get up into remember 150's extremes, so get up into that area, so that we can maintain the bullishness right now, the bullish trend, for even in this case from an options market expectation standpoint. Remember, skew is what people use to protect against big risks, right? So we had huge amounts of skew here at the end of 2024 going into the beginning of this year, and we saw why, because we had such a big move in such a short amount of time. It ended up being a shallow correction because of the length of time, but it was still a pretty decent drop, almost 20%. If you go from intraday high to intraday low, almost a 20% drop there. So it was a decent enough drop, and we saw, what all the skew protection was for when we experienced that. So let's take a look at our trade idea of the day. And again, remember, with the foundation level that you get, you also get access to our Market Outlook Live trades, trade management video, live stream that I do at the end of the market day. Every day we take a look at all the old trades we've been doing in old Market Outlook videos. You can see we've been doing pretty well on the ones that we still have going. We have one laggard there that we've talked about quite extensively, and why, we talked about why we're actually leaving it on there. And then today's trade idea is actually on FCX. Let's take a look at FCX. FCX had a nice good move here to the upside. Let's pull up the chart here and take a quick look at that. All right, so dark green shading, a green line, the intermediate line above, 90th percentile. So it looks very similar to markets. The market sentiment's rising above the 50th percentile. Near-term line's been bullish. It pulled back. But your momentum line was extreme on Friday, bouncing back up today. So that's a good sign for the stock. If you look at the weekly chart for FCX, you can see a big break above the 40 week exponential moving average. So a big change in sentiment here, hopefully, is the idea. As you can see, we're still in a death cross environment, but when you get that far above on the Hakineshi closing basis, above the 200 days proxy, right? That's our proxy. Then that's a good sign that things may be changing. You can see that here as well on the moving averages. You're above the 30, the 8 and 17 been above the 30 for quite a while, but they're above the point of control now. In fact, the 30 is at the point of control now. So any little pullback, there's some very, very strong support here. But now we're above the 200-day, right? We failed to get above the 200-day back in April, March, but we are above it now and holding the last few days. So that's a good sign for FCX. When you look at, as well as the materials outperformance, right? You kind of want to see that. But you're above 30 on the positive DMI. You're well below 20 on the, so your ADX is rising sharply. You have a very nice trend going on here. If I look at the RSI and the CCI, you can see they're bullish, right? Easily above 60, well above positive 100. So that's a good sign. The Ichimoku cloud is showing a strong trend, almost a mature level. We're at least at intermediate strength levels, almost at mature levels for that. And you can see, we're above the cloud. It's turned pink. We're above the cloud there. So we were bearish. There's the bearish move here that produced this cloud, is this drop. We have now crossed through, the rate of change has crossed through that drop, and we're above the cloud. As we approach the pink shading, we're above the cloud. So things have changed, right? The cloud's easily green. And if you look at the Bollinger Bands and the Keltner channels, again, similar to the S&P, the bandwidth had plummeted. But now we spent the last so many days above the bandwidth. We're above unlike the S&P, we're above the Keltner channel as well. And also, unlike the S&P, we have a green dot. So that means the bands themselves have moved back outside of the Keltner channels. So really, really good opportunity here for a vertical spread. And that's what we did. We did a long vertical spread where we sold the 45 strike. It's not very speculative. You're only getting about a 1.5, maybe a little bit less than 1.5 to 1 reward to risk ratio. But it's kind of more like a bull put spread. But we're doing instead of putting $1,000 at risk to make $400, we're putting $500 at risk to make twice as much as what we normally do on a bull put spread. So half the risk of a bull put spread to get twice the return of a bull put spread. So it's not the same odds as a bull put spread. It's still directional, still relatively low probability, but it's a higher probability directional trade because of how strongly bullish we already are. So we don't really need it to go up a lot. We just need to continue to grind. Like the market, we want it to continue to grind. and we can get a pretty decent return considering the probabilities for the trade. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open and pin a new thread with any questions or comments you have. That's going to be changing as well. We're going to be moving our forums off of our website onto Discord. And there will be a forum specifically for the foundation level for Market Outlook discussions. So, but as of now, you can use the forums on our site, or you can just reply on my tweet. As you see at the bottom of the Market Outlook blog post, there's the today's Market Outlook tweet. Just go ahead and click on that and reply, and let me know what you think. And reply to anybody else, and let's keep this conversation going. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.